Raising money and affordable housing. You think those are two relevant issues to real estate investors right now? Raising money and affordable housing. How much
does affordable housing even exist? That's the real question.
Depends on where you live, I suppose.
We might have to change that terminology.
Yeah, slightly more affordable than it used to be, or I don't know, compared to everything else out there. All right, let's look at a little picture here. Look at that. That's like a heat map, little dotted map of transactions you've done over the years. So that's 300 or so, right?
It's about 500 when you zoom
you
in.
You got to zoom in.
Yeah,
you're probably taking down several.
Yeah, it's a little shortcut. Yeah, we had one of my assistants. I forget what we were doing, and we're going through lists. I'm like, put that on a heat map, and we're targeting some properties that we're under contract, all that kind of stuff. And she threw it almost everyone on there, and there's some out of state and other deals that we've done that we could get a screenshot of. I'm like, holy crap, it's a lot of properties. But it just starts with one, It just starts with one, because when I started, Chris touched on it, like, I didn't know anything. Dead broke, living in an apartment, ground zero, no business experience, broke, hated my job, and here we are now. 500 plus, we've kind of lost count, but yeah, a lot of deals.
You remember this deal?
I do. Yeah.
This one ring any bells?
Yeah, that was that was a flip we did last year.
So you're still able to do deals in this market?
Oh yeah. And then the interesting thing about the previous slide, you don't have to go back to it, but 99%, maybe 98%, because in the beginning, my first year, I'd utilized a few banks. All of the deals that we've done, 500 plus, the initial acquisition, all with private money. With the exception of my first 2 years, I did about 25 to 30 deals with hard money originally, and then we refinanced. Since that point in time, private money. We've gone with a couple of banks initially. We actually bought a park initially with financing, but that's all private money for the most part.
Just to kind of make sure we're all on the same page with private money. Like, what is private money? What is a private money lender?
Yeah, so a private money lender is essentially like a bank, like a hard money lender, but they're just an individual. Okay, so they're going to loan you X amount of dollars with a certain agreement. It's quasi hard money. It's very, very similar structure. Typically, the rates are a little bit more favorable to us as a borrower. Not all the times. There's private lenders that, same rates and fees as a hard money lender, but there's usually some flexibility that you can get in maybe the way that payments are structured. Maybe you have accrued interest. Maybe you don't pay any points. Maybe you have delayed points. Depends, but there's typically a little less structure than a hard money lender, right? Or a bank for sure.
So it's an individual person that has money in their bank account, in their savings account, in maybe an IRA account that, hey, I like you, I like this deal, I'm going to loan you money on that deal, right?
Yeah, and typically, 60% of our hard money capital does come from self-directed IRAs. Like a small majority of it is a small majority, and then minority of that is cash. But most of it comes from self-directed IRAs.
Okay. And I do want to differentiate. So we have private money lender, but there's also a private investor, someone who may be investing, say, in like a syndication, because we'll get more into that later on. But what's the difference between a private money lender and, say, like a private investor that would be investing in like a syndication?
Yeah, so a lender is basically, look at them like a bank. Okay, it is a source of capital for your deals. Okay, but it's heavy relationship based. It's based on the asset as well, but that relationship is extremely important in that relationship, along with the asset. Then there's, I don't know how far you want to go right now, like into syndications and funds, but there's other ways to structure these deals. Like we do, occasionally we do equity participation mortgages with our lenders. So we've done this like in times where maybe there's a little less certainty in the market, and we want to safeguard some of our risk, fully disclosing that to our investor/lender, but also sharing some of the upside with them. So we just finished an equity participation deal, and we were doing a lot of these to jump back right after Hurricane Harvey. Because after Hurricane Harvey hit Houston, and we're getting flooded with like high-end homes in Memorial and Fleetwood and all this kind of stuff, and I'm like, I invest in median price housing and below. We don't do a whole lot of flipping $1 million houses and stuff like that, but we were just getting some incredible deals, and so we just figured out a way like, how can we take these deals down and safeguard our risk? And so the way we did it was with equity participation mortgages. And short summary is that rather than paying these lenders, say 8, 10, or 12% interest, we'd pay them maybe 3 or 4% interest, okay? 3 or 4% interest in case we had to rent that property and wouldn't sell right away. We need to make sure we could at least break even or have a little bit of cash flow. So, and they're getting some type of return on their money. And then whenever we eventually sell that property, it could be quick, it could be long term, then they're getting they're getting some equity in that deal as well, so they can get, at least double-digit returns on their money, most likely. But then if everything went wrong, hey, at least they're getting 3 to 5% return, right? But they want to invest a little bit on the upside of that, if that makes sense. So the cool thing about private lending is a lot of times, like, I always say this is most of my private lenders are really like, they've become friends, and their partnerships, even though they are a lender lending to me with like a mortgage and a deed of trust, they're relationships. And so there's some flexibility in there in how you do deals.
100%. I'm sure you're working with an attorney to draw up these documents. It's definitely very important, especially when you're dealing with equity and stuff like that, because there's some things that you want to make sure that you do, and some things you want to make sure you don't do, and things you say and things you don't say to keep everyone from getting in trouble, right?